The second you hear something bad, like we're attacking Iran, before anyone even knew what would happen, markets reacted badly, right? So having a high fear consistently, how do you guys think that's going to change mortgages?
So, nothing can stop me. I'm all the way up.
Good morning, Vietnam.
There it is.
Welcome to the Money Matrix podcast. I'm Mayer Dallal, your host. We have here with us in office Jason Mantione. Alan Hastings, our resident California, has flown in.
Special episode.
Special episode. We're trying to bring him to the other side. I don't know if it's going to work, but we're trying. And then we have Jason Rod with us over in Arizona. So, gentlemen, today is going to be interesting because we have a lot of things to unpack, and really what I like to call it is the fear economy. You have rates, you have war, and no one knows what's coming next. That's really the crazy, Clients call me and say, Mayer, we had great news today. Rates should come down. I said, it doesn't mean a thing. Literally yesterday, the market was up 40 basis points. The 10-year was down 10 basis points. Yet several of our investors made worse rates. Their rates got worse, and a handful got better. So what happened? No one knows what's going on. And that's really what the problem is. So if you're self-employed, if you're a 1099, if you really don't get as impacted by the prices as much, but it affects everything else. Whereas if you're a W-2 worker, you're getting crushed by the prices, and your propensity to make more money is somewhat capped. So your qualifying purposes, where you thought you were within range to qualify over a month ago, that's completely out of the ballpark now. And that's scary. And that's really scary. If you thought 30 days ago you could qualify for a home, today, you can't.
It's scary to think about that. And I think there's a lot of confusion as well, because most people don't quite understand. Like you're saying, a client will call you and they'll say, hey, I saw this on the news. I saw XYZ being said. Specifically, the Fed, and a lot of people not quite understanding, the Fed doesn't control the mortgage rates directly, right? They're indirect. So whenever someone sees on the news, oh, the Fed cut rates by an eighth or by whatever, they're immediately like, I'm calling up my lender. I got a rate cut today. This is great.
Yeah.
And 90% of the time, it's just not true. The 30-year, our fixed mortgages track the 10-year Treasury yield, which is set by the bond market every single day, generally at an inverse to the actual rate set by the Fed. So we're in, this position where the market dictates how we price, which means the news that you get, that you see on the news, every other investor is getting, the market's reacting to that news. We all knew the Fed was going to cut rates a week before they did it. The market priced it in a week ago. So you call me up all excited, like, hey, I'm so excited for my lower rate today. And I have to break the news to you that you're already on your lower rate,
Exactly. And if you look at it, Jason and I were talking about this, Jason Mantione, and before the war even started, the 10-year bond was at 398. 398. Remember, Jason, we were having that. It's like a little over a month ago.
Yep.
And then today, or I think at the high it was a couple of days ago, it was at 445 or 447.
Wow.
So whatever possibility of any gains or anything like that we had was completely.
Break that down for our listeners. Like, what does that mean to them from going from that 390 to the 440?
So I'll give you an exact, and Jason Rod can speak to this because we just had a client who was in this situation. So when it was the 398, your regular conventional rates were trending around 6% to 6.25%. And your non-QM rates were trending at about 6.375 to 6.5 for comparable scenarios, just using the alternative documentation. Today, your average 30-year conventional fixed mortgage is trending between 6.61 and 6.65. Your now non-QM loan is trading anywhere between 7% to 7.125, 6.99, depending on the scenario.
Yep.
And Jason Rod has a client that we were ready to lock in, and he told the guy, listen, lock in. Things are weird. Just lock in. He's like, no, I'm not ready yet. What happens? The Fed's meeting in a couple of weeks, and they might drop rates. And Jason, what was the conversation you had with them?
Basically just letting the client know that, they got to know the whole story. It's not that the Fed's just going to cut rates, but we're forward thinking and looking at the market. It's about rates, oil, the consumption,
Inflation.
consumer consumption,
Mm-hmm.
all these different factors that go in to move the 10-year treasury, right? The 10-year treasury is really our bottom line of, if we see something forecasting that it's going to possibly be news and market affecting, we're going to let you know ahead of time. And that's what I was trying to do. I was trying to let them know and say, hey, I see this coming down the pipeline. There's 3 different news reports coming out. These are ones that always get redone and have revisions down the track. But the difference to you now is that it costs money to you, right? It's either going to be a higher rate, or you're going to go ahead and pay more into the deal. And I don't know, my goal is to look out for every single client as best we can and do our homework. But really, it's helping our clients understand the whole story and not just, oh, the news told me that rates were cut, so things are improving,
Exactly.
right? Or I want to hold out. Trust your professionals.
It's so true when you say trust your professionals, because as a self-employed person, I mean, we deal with majority self-employed gig economy workers, investors,
Foreign nationals.
The foreign national, the more successful you are by nature, the harder it is for you to qualify. If you go to a bank, and you guys guarantee will be able to agree with me on this. If you go to a bank with multiple sets of tax returns or not, or just the simplest form of making money, I got a call in just today from a woman who found us on ChatGPT. Her name is Susan. She searched best non-QM bank statement lender or something like that, and ChatGPT spun out our name, and she did 3 different variations and just spun out MBank. So she called. She said, "Listen, I'm buying my dream home. It's a new build, but I make money. I know I qualify because I deposit $10,000, $12,000 a month, but the bank says I don't qualify." So again, she's successful. She's a nurse, but she only keeps her nursing job of $40,000 because she has to keep her license active. But she does in-home healthcare, and people pay her via check. They don't give her a 1099, but she's self-employed, and she files as a self-employed person. So her deposits range between $10,000 to $12,000 a month. She's got money. She's saved. Her current house is paid off, and the builder told her straight up, "You don't qualify." Successful, 780 credit score. Her accountant's doing his job, but the bank looks at the wrong number.
Mm-hmm.
It's so frustrating as a loan officer. I watch these traditional lenders just crushing people's dreams, like people, just because you have non-traditional income doesn't mean that you should be penalized. You got to be forward thinking. You got to open your eyes, take off the blinders. There's all kinds of programs out there to help people. And with us specializing in helping self-employed people and non-traditional income, I got to tell you, it's a personal gratification for me. We all have, we all have our duty to look out for them. But when it comes down to it, I mean, being able to educate people and show them that, hey, you're self-employed, you make a bunch of money. Amazing. Yeah. Let's qualify you off your cash flow versus, oh, you wrote off all these things and you brought in $1 million in deposits and you only claim 200,000 because you're smart enough to use your tax codes in your certain state or business. Shouldn't be penalized, but it does us a lot of good.
Let's get back on track. So oil, Alan, you're the stats guy. Before the war, oil was trading at what, $70 a barrel?
Yep. And now I think we just crossed 110.
So effectively at the gas station, and literally this morning I called Alan. I said, I'm at Costco. I drive like an extra 7 minutes away to go to Costco because for me, I'm thinking, all right, I'm getting the best deal. Literally, it was $4.50 a gallon for $4.49 for premium gas. And I remember before the war, I was telling Jason it was under $3
Mm-hmm.
or $3.03, something like that. That's a 50% increase at Costco.
And that's just here in California. We're over $6 for standard, not for premium gas. Like $5.99 is like what you see at the pump every day. And why is that important? Why is gas important? Does anyone want to chime in on why this matters?
Well, gas
Oh,
it runs everything.
this is a loaded.
Yeah.
I got a lot to say,
Mm.
but it comes down to what's happening in Iran with the war, and having 5 vessels go through in a day versus 100 vessels. 20% of the world's market is being held up, and if you think this is going to be inflationary to our economy, it is, because I mean the ships got to get here, the trucks got to deliver. Everyone is using their gas and they feel it in real time. You could tell me oil is $120 a barrel. I wouldn't care until I go to the gas pump like Meyer did earlier today, and it was 4.50 for premium gas, which is a 50% increase in 30 days.
But it's not
And
just
that's
that.
hitting real people
It's
real time.
food. It's everything. I mean,
Everything.
I was watching an interview. This guy in China makes some like a widget or whatever that's needed on every like automotive part. Like it's essential to where it has to. So he's like, yeah, I just raised prices by 35%, but I might have to do it like another 50% because the cost is too high. And if this Iran things keeps going on, but really people don't understand, and this is my opinion. I mean, at the end of the day, what all this has to do with, it's not just oil. It's really the dollar.
Yeah.
Because if Iran and China get their way, they want to peg the whole world financial system to the yuan, to the Chinese currency. Now, in theory, you're going to ask, well, what's wrong with that? But the reality is you don't know what the value is because it's completely propped up and held up by the government.
Correct.
So there is no true inherent trading value. There is no inherent value because you can't trade it. You can't buy it. You can't flip it. You can't really do anything particularly in a mass scale. I'm sure there are people that can arbitrage to some degree. I don't even know that. But in general, think about it. They're trying to peg a whole system to a currency that's artificially held up by the Chinese government.
I do want to
What's
say, oh, you go first. Go ahead.
I just want to just say something that I was watching on the news the other night. It wasn't the news. It was just like a segment. Long story short, not high-end restaurants, but like burrito bars, pizza shops, this, that, and the other thing. So what's been happening, so, the past 4 or 5 years, whatever, as inflation and whatnot has been going up, obviously these people are raising prices on the food. So now there's a couple of spots, handful of spots that are staying really, really busy, while the other spots now are starting to slow down because they keep raising prices. So they did kind of like a blurred out face on cooks at these different restaurants, Las Olas, West Palm, Clematis Street, downtown Miami. What are they doing? They are keeping the prices the same, still getting that $10 burrito, but instead of having 8 ounces of chicken in it, it's 6 ounces of chicken and it's extra lettuce or extra rice. So what they're doing is they're making the food cost exactly the same per se in that burrito,
Right.
but giving you less of what is the ingredient that is more expensive. So now, so the moral of what I'm trying to say to you is the restaurants are, they know that they're pricing themselves out of business because people, what are you going to say? We can't go out to eat anymore. We're just going to cook at home. In order to keep these people coming in the door, they have to keep the prices the same. So now they've kind of found like a loophole to keep that burrito looking exactly the same when it really isn't, to
Right.
keep it at $10. So it's just what's going on in the world today that somebody had to sit down and say, okay, let's have our food costs exactly the same so we don't have to raise the price, so we keep people coming in the door so we can stay in business and keep Joe, Jim, Tina, and Christine, employed to have a job.
I just imagine.
I mean, this is America. Is this what we're supposed to be doing? What's going on?
Go to a burrito
Well-
shop tomorrow and you're going to take a bite. It's all lettuce, the whole
Yeah,
thing.
you know what I'm saying? One piece of chicken. Where's that chicken?
You got to find it in the lettuce.
But it's just, I just wanted to share that because I just got a kick out of it that people are becoming that creative in order to keep people coming through the door in business.
And just to give a shout out to the self-employed people and the restaurant owners out there being able to adapt and overcome and, change their business models in order to be able to stay in business and
Absolutely.
employ people,
Absolutely.
keep the economy going.
We do a lot of work with restaurateurs, a lot. And,
Yeah.
and really, I give them a lot of credit because we see their bank statements. I mean, we see what comes in and what goes out, and they're doing their best to push through this. And the ones that are more entrepreneurial and more risk-taking, they're the ones that are actively going out, buying property, doing whatever it is, taking from one business, putting it into the other, because they don't want to depend solely on that grind.
The
They
eggs
don't-
in one
and-
basket kind of thing.
they don't want, they tell me I'm doing this so I can get to real estate. This is my means. Alan, you're the numbers guy. Tell us about the numbers, the VIX, the CNN Fear and Greed Index, because that is scary. I remember I don't remember the last time. Actually, I do. In 2008, when the VIX was this bad.
So I'm going to explain what the VIX is. I'm going to read you a definition so that I don't get it wrong. The CBOE Volatility Index. So it's Wall Street's fear gauge. It measures the expected S&P 500 volatility over the next 30 days based on options pricing. So basically, they're trying to gauge how the market is being viewed for the next 30 days. So calm markets have a lower VIX score, VIX, VIX. Scared markets produce a higher VIX score. Below 15 is complacent. Above 25 is where institutional investors genuinely reposition portfolios. So you're basically 15 is your floor of things are all right. 25 is we got a problem.
Mm-hmm.
As of right now, March opened the month at a 22.4, which is just under the ceiling at 25.
But it hit a peak of
This is following a 12% single day spike on March 2nd, where it climbed to a peak of 27.3. And that was the highest in nearly 2 years, following right after the oil shock, the inflation reports, and everybody is basically terrified that this is going to be going not just sitting above 25, but even higher. And I'm very curious. Each of us have our own opinion on what fear means. And we're all here saying, you've heard of, if you've watched a pod before, we all say the markets are driven by emotions, not 100% by fact. I mean, we all look at earnings reports and change our portfolio, whatever. But the second you hear something bad, like we're attacking Iran, before anyone even knew what would happen, markets reacted badly, right? So having a high fear consistently, how do you guys think that's going to change mortgage rates?
so this is a great point. And this is something that fear is working against the consumer twice now. Twice. First, just the whole concept of the war and the oil. Now, on a market level, the VIX, the CNN Greed and Fear Index. So these are all trending high. So what happens typically in the market when portfolios get realigned? They sell out of speculative stuff, stocks, and they go into bonds, typically. When there's more purchasing of bonds, what happens to the rates, Alan?
Rates are going to go up.
Why?
It's an inverse.
It's an inverse, because if there's more demand for bonds because there's a flight to safety, then you're going to have to pay more of a premium to get money to come in. That's just the nature of what happens. When you have so much money, they're going to say, okay, no problem. We got to keep doing this. So this is what's happening now. So when Joe Restaurant or Dave the plumber or whatever goes to qualify to buy a home, the rates are going up. Now, simultaneous to this, you have David the seller. He's freaking out now. He's got to close on his other house. He's already in contract, ready to go. And he's not getting any offers because what he thought was a great market to sell into, spring is coming, everything is great. Now he's getting annihilated. So you as an investor, as a buyer, as a primary buyer, whatever it is, now is your opportunity to strike. When the VIX is high and the fear indexes are high and everything is high, potentially rates could be a little bit higher. Now is where you go in and pick off an extra $20,000, $30,000, $40,000 off of the price of the home. Negotiate a seller concession. And you know what? You're still in a two-step process regardless of what you're doing. Today, if you purchase today, you're going to refinance in the next 3 to 5 years. Rates will be down somewhere in the fives, my opinion. So regardless, now is where you take advantage. You can't be scared forever. You have to step in when the market's right. And now is the market right timing, in my opinion. Thoughts on that?
I 100% agree with you, Meyer. I mean, let's say, just for an example, you have a $600,000 mortgage, right? And you're at a certain percentage and it goes up a half a basis point. That's going to be $60,000 over the term of your loan, which is 30 years. And this is at that elevated rate that we're talking about, right? Now, in my experience talking to people, they're looking at that $60,000. They're not looking at the $175 additional per month to their payment. Now, we always say it, and it's kind of cliche, you know, you marry the house and date the rate, but it couldn't be more real in times like this. And yes, it does cost you a little bit more right now to get into it, but if you can afford it, it's better to pay that 175 until the market recorrects versus the 60,000 at the end, and not step in, and not to mention all the equity gains that you're going to be getting in there. You know, average, what is it, 4% nationally, Alan? Something
Yeah.
like that?
Yeah, the Case-Shiller just came out.
What is it now?
I want to say it was 3. Just check it real quick. The
Sure.
Case-Shiller came out 3.6. I want to say.
So
So
you're
close to
saying
4, mid
Yeah,
threes.
yeah.
You know, so
Yeah.
you're missing out
So
on the
that's-
equity gains.
You're
So
missing out on
it's
the
just-
equity gain across, you know, just from a you know, a holistic view. I mean, you know, it's, what do they say? Penny smart, pound foolish.
Mm-hmm.
So, but, you know, a lot of people ask, what does the future look like? Obviously, no one has a crystal ball. But the reality is, this is my opinion, right? You have rockets and you have feathers. When things like this happen, rates rocket up. And what happens? They come down like a feather, slowly, because it's a lot easier to gain weight than to lose weight. Same type of concept.
Mm-hmm.
But at the end of the day, this is where you get in. And again, I can't keep harping on it, but this is the reality. Rates will come down. At some point, this whole thing will get resolved. Whether it's completely obliterating Iran and starting all over and putting in a new regime, making a deal with the existing regime, I don't know. Selfishly, I'd like a new regime completely altogether where I have a shot at possibly going to visit where I was born. But that's selfish reasons. But either way, it'll get resolved in my opinion. And I think with the new Fed coming in and the new chair coming in, they're eventually going to get to the point where they're going to start dropping rates again. But that's going to be a gradual. He can't come in and drop 100 basis points.
No, of course.
So it's going to be a quarter. And then it's going to get into 2027 before you see anything really meaningful.
Agreed.
But so if you're waiting for rates to come down, to refinance and cash out, to, you know, to buy another home, to make an investment, to do
I'm
anything,
going to miss the boat.
you're going to miss the boat. Rockets and feathers.
Mm-hmm.
It's all a matter of perspective. If the numbers make sense financially and if it works for you, you have to do it. It's not completely an emotional decision anymore. It's an actual business decision. And if it makes sense and you can support it and you can financially do it, this is where you will make money. And again, I was talking to a client today. He said to me, Mayer, after all the dust settles in the next 3 to 5 years, Florida home prices are going to double, in my opinion, in the next 3 to 5 years.
That's quick.
He feels there's going to be a lot of opportunity. You have a lot of areas in Florida that got hit hard with the extra inventory and what's happening. And I think there's a chance of even if it's up 50%, it's still a win-win.
This is the same scenario we had. Like, this is almost the exact same scenario we had. If you guys recall, like 3 years ago, two years ago, we were selling rates in the 9s and we're telling people like, get a seller concession, get credits for closing, you know, like rates are bad, but you're going to get insane discounts on your house. And then you do the monthly payment, you make this extra high monthly payment for 2 years. You still made out like a bandit with the seller credit being more than you paid over the 2 years. And then you refi. And we've hit those clients again. Those exact people have refinanced with us already. They're in 6s now. And then we expect, you know, when the rates come down, they're going to be in 5s in a year or two.
Mm-hmm.
And all those people, they took, you know, they took that extra 100, 200, even sometimes up to $1,000 a month in higher payments. And it was still lower to hold that for 2 years. $1,000 extra a month for 2 years. You're going to be paying $24,000, right? You got a $30,000 seller concession. You still win, you know? So now's the chance, just like it was then.
You know, Jason Mantione does a lot of foreign national business, a lot.
Yes.
And, you know, what people don't realize, these people are moving. They're making moves while everyone here in the States is waiting. Why? Because they've already experienced the crazy inflation, the crazy political instability. I mean, you have people from Canada who sees the crazy government there. You have South America who's got political instability. Mexico, who's completely under extreme war right now in Puerto Vallarta and all these places, South America, Argentina, where their money is devalued. So they're all already, they're saying, wow, 7%, 8%. Thank you so much. I appreciate it, because they're burying all their money here because the prices of homes are going up. And you know, it's funny. Jason and I had a conversation. And what'd you guys say, Jay? Didn't he say, why aren't these guys buying properties? I don't understand. What was the conversation?
Well, with the foreign nationals?
Yeah.
Well, here's the thing with a lot of the foreign nationals, just like you just said, I've always, and even my brokers that actually that give me a lot of my clientele, and you know, they go through the brokerage houses, say in Canada, they already know that they're going to be in the eights. Even, you know, all the time, I've always had them in the eights. So they're basically, you know, the rates really aren't bothering them that much. They, like you just said, they're going from a really, really bad place where the rate really doesn't bother them that much coming here. And I also have, you know, we have the discussion that, listen, this is a temporary thing. I'm going to refi you out of this rate in the next, let's say, even let's go long term, let's say 3 years. But 2 to 3 years, you're going to be out of this rate anyway. They are more concerned about buying the home now, getting out of where they're from, renting that home out, starting it now while the prices are down. Because, you know, listen, I'm in the construction business. I'm all about, once rates come down, home prices go up. So now is the time where you want to get in and you want to buy. But I haven't seen any kind of decline in foreign nationals coming, except the only thing that I have seen, and since I'm sitting with Alan this week, has also heard it. You know, I have people out there that can't get these foreign national loans done, and you know what hurts me? They're lying to the clients. We had a client come in this week, and the broker couldn't get it done. Said he couldn't get it done for whatever reason. Gave the client a rate at 5.85% for a foreign national. It's not even true.
Yeah.
But the problem is they put it out there. So the answer to your question, go ahead.
The question, though, is they asked, we were on a joint conference call. They asked us, why aren't your local people in the United States buying more properties? And the truth is, what I said to him, he was shocked. I said to them, really, the truth? The ones that can do it are scared.
Yeah.
Or they don't know that they can qualify.
Yeah.
That's your two options.
Right.
Okay, you know you can qualify, but you're scared, or you don't even know these programs exist. As a self-employed person, and again, I harp on this because this is the majority of the business we do, so I apologize. 1099, an investor. Either you know and you're scared, or you don't know. Well, now you know, and now you got to get off and start doing things because the opportunity's here.
Now,
That's what I'm going to leave it with. Any final thoughts, gentlemen?
Something I notice in my day-to-day is that so many people are rate sensitive due to the cycle of news and the uncertainty in the stock market in the world of what's going on. Empower yourself, work with the professional, and become program aware, because there are solutions for people with non-traditional income. There are solutions for people even with traditional income, with loan products in our space. So talk to your non-QM lender, shop the rates, but definitely talk to us. And that's it.
Thank
you,
you
Jim.
all. Appreciate it. God bless.
thank you.
Nothing can stop me, I'm all the way up.